all of these stocks that I read on that list, plus others that are down by significant amounts as well, are really going to come back to the prior levels they were?
Absolutely. Absolutely. And beyond.
Cathie Wood, right at the epicenter of that bubble, believes all the hype, believes her own bullshit. She believes all the presses about how great she is. And so it all feeds her ego, and she believes all those clippings, and it has so distorted her sense of reality. And so even now, as she is staring reality in the face, she still doesn't recognize it. She still expects these stocks that she owned, some of them that are down 70, 80%, she still believes they're gonna make new highs. She is living in a fantasy land. And the most frustrating part about this is the attention that she still gets in the media, the platform that she still has. She's on like CNBC constantly, all week. She's always there, and they let her tout her funds. Even as the price keeps crashing, she's on that network urging people not to sell, urging people to buy, and her followers are following her lead. Like I said, it's the blind leading the blind. Now, yes, when she's being interviewed, they do question her a little bit, but they don't really press her. They throw her softballs, not hardballs, and they accept her rationalization for what's going on. Some of the things that she's been saying that are just utter nonsense. One of her contentions is that because her fund is down so much, right? It's down 50%. She now believes that she is a deep value fund investor, that the ARK Innovation Fund is now a deep value. Like, it's not just a value fund, it's deep value, meaning her stocks are way undervalued. That's not even close to being true. In fact, the opposite is true. Her stocks are more overvalued now than they were when they were double the price. Now, how is that? Well, because the fundamentals have changed. First of all, the momentum has changed. When the fund was double the price, it had a lot of positive momentum, and that positive momentum had some value. Well, now it has negative momentum. Well, that subtracts value. When stocks are going up, there might be some type of expectation built into the price that they're going to keep going up. But when they're crashing, how are you going to build that expectation in? In fact, if anything, the expectation is the trend is your friend and it's going to continue. And in this case, the trend is your enemy if you're Cathie Wood. So on a pure momentum basis, her fund is less valuable and her stocks. But think about the interest rate environment. Think about the inflation environment. Her stocks were in favor in a low rate, low inflation environment. When you have higher rates and higher inflation, that means that growth stocks, by definition, become less valuable, because when you are valuing a growth stock, you are trying to value income streams in the distant future and then discount them to the present. And an important factor in valuing those future streams of income is the interest rate that you're using to discount them to the present. And interest rates are going up. So the present value, the discounted value of those future cash flows has diminished. Cathie Wood doesn't understand what's going on. Her stocks are even more overpriced now based on the change in the fundamentals than they were before they dropped. So there is a long way to go before these stocks become fairly valued, let alone highly discounted valuations. She is living in a fantasy land, and investors are just blind to what she can clearly see. She's the one that's blind. The point that she's trying to make is that investors who are looking at the past are making a mistake. That if you're buying stocks just because they've made profits in the past, you shouldn't buy them with the expectation that they'll continue to deliver profits in the future. What Cathie Wood doesn't seem to understand is how difficult it is to see the future. I mean, she thinks she's clairvoyant, right? Again, she believes her own press lines. She has a crystal ball. She knows what companies are gonna win. You don't. I mean, let's say there's 100 companies that are potentially gonna disrupt the market. Maybe only one of them does. Maybe 99% of them go to zero. Cathie Wood doesn't know which of those hundreds are gonna succeed. She just thinks they're all gonna do it. And maybe she thinks, well, I'm just diversified. Maybe none of the ones that she picked will succeed. There is huge risk in what she's doing. She's acting as if it's easy. But what may be more significant than how clueless Cathie Wood is, or that CNBC brings her on so often and gives her a platform to spew all this nonsense, but why CNBC feels that it's so important to constantly bring her on and give her that platform. And I think it's because CNBC is playing to their audience, because most of the CNBC viewers own a lot of the same stocks that Cathie Wood owns in her funds. In fact, a lot of their viewers probably own her fund because she's been on so long touting it. And she's basically like the messiah of all of these faithful CNBC viewers. And so they bring her on so that she can preach to the faithful and give them hope. The goal is for the people who own these stocks not to give up hope, not to jump off of a sinking ship. But of course, that's exactly what they should do. The ship is sinking. Why go down with it? That's exactly what Cathie Wood is advising people to do. But you know, this Cathie Wood phenomena where CNBC brings Cathie Wood on because they know she's what their audience wants to hear, because their audience is full of people that own these stocks and they want to hear from their messiah. They want to be reassured that everything's going to be okay if they just hold and hope. It looked like they were getting it right for a while as air was coming into the bubble, right? Everybody thought Cathie Wood was a genius when other fools were buying the same stocks that she did. But now that we've run out of fools and the price is going down, I mean, she's going to be the last fool left. She's going to be screaming from the rooftops as the house that she's standing on is on fire that everything is great, that my stocks are going to make new highs, that everybody else is wrong. It's not just stocks that are decoupling. It's going to be the economies. You're going to see the global economy, particularly the emerging markets, completely decouple from what's happening in the United States. If you have an inflationary recession, if you're in stagflation and you resort to the classical Keynesian remedies for recession, you are at the same time making the inflation worse. But if the recession is being caused by inflation, what you're doing to make the recession better actually makes the recession even worse by making the inflation problem worse. And that is where we're headed. I hear a lot of people talking about the benefits of cash. Even though cash has no yield, a lot of people on Wall Street are touting cash for its optionality. Because if you have cash, that gives you the option of buying stocks if they get cheaper. So in other words, it's this dry powder. So don't think about cash in terms of the yield because you're not going to get any. Just think of it as giving you some optionality, because you could take that cash if the markets tank and now you can benefit from the collapse. You can buy stocks cheap. Well, I got a better idea. Instead of cash, use gold. Because inflation is 7.5%. Again, it's 15, but let's just use the government numbers. 7.5%. If you stay in cash, waiting to buy bargains in the stock market, you're losing 7.5% while you wait. I mean, if you wait all year, you've lost 7.5% of your purchasing power. Instead of keeping your dry powder in cash where it's actually getting pretty wet, how about if you store it in gold? That is a much better place to be if you don't want to be in stocks, because you have the same optionality in gold. You can use your gold to buy stocks. And in fact, I think it gives you greater optionality, because as stock prices are going down, gold prices are going to be going up at a minimum to offset that 7.5% inflation. Now, is it possible that the price of gold could go down with stocks? It is possible, but it's likely that if that happens, stock prices will go down a lot more than gold prices. So you still have the benefit of being able to use your gold to buy stocks and be ahead of the game if stocks drop more than your gold. Now, yes, if you own cash, your cash can't drop at all. So in that respect, you could say, well, cash is a little bit better because there's no chance that cash is going to go down. And there is some chance that gold's going to go down, which is true, but it won't go down as much as stocks. But on the flip side, there is no chance that cash will go up. There is a very good chance that gold will go up. In fact, it's highly probable that gold will go up. So if you view the whole thing in its entirety, downside risk, upside potential, if you don't want to be in stocks because you think stocks are overpriced and you want some dry powder so that you can take advantage of lower stock prices in the future, what's the better choice? Cash or gold? Gold wins hands down. I mean, maybe if we had a high interest rate environment like in 1980, if you can get 14% on your cash or 20% on your cash, hey, maybe cash is better than gold. But when you're getting 0% on your cash and you have zero upside then on your cash and you can buy gold this cheap, clearly that's where all the optionality is. So all these people that are touting cash as a defensive play to give you optionality to buy cheaper stocks should be touting gold instead, because the real risk of holding cash is that we have hyperinflation and then stock prices actually go up. If the government interferes, if the Fed interferes to reflate this bubble and you're caught holding a bunch of cash, you're going to lose on your cash because cash will lose more value than stocks. But if you own gold and that happens, then you're fine because stock prices will go up in that situation, but gold prices will go up even more. And then you still have the benefit of being able to buy cheap stocks because they're going to be cheap in terms of gold. They won't be cheap in terms of paper dollars, which are going to get even cheaper, but they will be cheaper in terms of real money.